Welcome back, guys. I would like to start a series of personal finance and especially a personal finance journey. So the first episode, I would like to discuss why we have to invest. So in general, we have to save up the money to invest. And the expectation is having money tomorrow. So investing is a way of not using money today in order to get more money tomorrow. Now, why we want to do that? For different reasons. For instance, we want to beat inflation. We want to invest in ourselves. If tomorrow I will have more money aside, what I can do, I can use that money for a travel, to study, improve my professionality, and so on. Another good reason is economic tranquility. If I have a certain amount of money aside, so I live in a different way than basically count money every time I have a bill. If there is an emergency, there is something, I have money aside that I can use. I can have money that I can basically exploit in order to overcome some problems. And then one of the most important reasons is retirement. Today, in all around the world, more or less, it's very difficult to retire at a good age, let's say. And then when you retire, let's say that we will not have the same amount of money that our parents had. So it means that we will have less money, we will have less basically guarantee about the amount of money that we will have maybe in 10, 15, 20 or 30 years. So it's better to plan now the retirement since we have time. Then the important thing, start now. Create a saving plan and stick to it. For instance, I want to save up $10 per month. So the important thing is to say, I don't want to put money in immediate things, expenses, and so on, unless they are really there is really a good motivation, a good reason to do that. But then I want to deprive myself of certain amount of money, of certain amount of things, because I have the time to save the money and to invest. Because otherwise, what common people do, it's just, I will save tomorrow. With this kind of mindset, you will never save up enough money for the retirement or for your personal projects or whatever. Now, what is inflation? Because we have talked about beat inflation. Inflation is caused by a rise in the price of goods and services. So, supply reduction and demand rise drive goods and service prices higher. For instance, during the COVID, in certain countries, the government has sent more or less money for free to people. And this, what has caused? It's caused a demand rise because they have more money to spend. Now, people need a diversified set of products: food, fuel, electricity, services like healthcare, transportation, and so on. And inflation measures the average price level of a basket of goods and services in an economy. And especially inflation is related to a specified period of time. Consider also another thing. All the countries, what they want to do is to keep inflation at more or less 2%, because they have to boost the growth. And so it's more or less normal that you have 2% of inflation. And this is, let's say, normal or low inflation. But there are some periods, like in the past 1 or 2 years, where inflation raised up a lot. There were something like 5%, 6%, in some countries even 10% of inflation. And this is basically, let's say, the rate, the price of goods and services grow. It doesn't mean that if at a certain point inflation go down, for instance at 2%, prices go down. No, it just means that basically prices increase at a different speed. So we can say basically inflation has the speed to which prices of goods and services increase. Now, for instance, if this is a very simple example to explain what is inflation. If I have $1 today and I can buy a cup of coffee, maybe in 1 year, I cannot even afford that cup of coffee because the cup of coffee is not anymore $1. It's maybe $1.05. So basically something like 5 cents more. So it means that with $1 I can buy fewer products and services. Now, let's see an example. The coffee cup price rise. In 1970, the price was at $0.25. So with $1, I could have bought 4 cups. 2024 is at 3.5. Consider that these values is an approximate average coffee prices in the US over time. So in 2024, I cannot even buy a cup of coffee because the cost is $3.5. And these prices basically reflect the cost of a regular cup of coffee. And the price has been influenced by inflation, supply chain costs, and market trends. So you can start to understand that basically your dollar in 1970, in 2024 has lost buying power. So if you want to invest, you have first to save money, then invest money, and the invest money is a way to beat inflation. Is a way in general to keep the buying power and not losing it, leaving money on the bank account or in the mattress or wherever you want. Now, how can I protect myself from inflation? But I can consider asset classes. Probably you have heard a lot about this word, asset class. Asset classes are a group of investment with similar characteristics. And they are subjected to the same laws and regulations and so on. So what we want to do, we want to choose one or more asset classes that can outperform. For instance, let's see some asset classes, quite common. Commodities. Commodities are basic raw goods that are used as an input to produce other products and services. For instance, commodities like wheat, sugar, oil, orange juice, and so on. What's the issue? Because each asset class has, let's say, if I have to consider how to build a portfolio, I have also to consider, let's say, the pro and the cons of an asset class. The cons, so the disadvantage of the commodities is that they are highly volatile because they depend on the supply chain demand, on the geopolitical situation. Let's consider, for instance, the price or the, let's say, or the amount of fuel that I can have that depends on a certain kind of a geopolitical situation. The same thing can happen with wheat and the war in Ukraine. So they are really highly volatile. Then I can have the famous 60/40 stock bond portfolio. So here we are just considering some kind of asset classes that I can use to protect myself from inflation. I can use one, more, or the important thing is really to know how many I have and basically what have the pros and the cons so that I can think how to create, let's say, a portfolio with a certain kind of instruments that help me to invest, protect me against inflation, and have more money tomorrow. So this kind of portfolio, it's made of 60% of bonds, of stocks, and 40% of bond. It's a conservative portfolio and could keep safe against inflation. What is the issue? Well, simply it underperforms under the long term with respect to an all equity portfolio because of the compound interest. Another asset class are the real estate investment trust. So the REITs are a pool of real estate that pays high dividends. So what is the disadvantage? Well, if we are in a situation with high inflation and then the central bank, European Central Bank, the Fed and so on, they start to raise interest rates, well, the TIPS that are a special kind of treasury bond, they become more attractive than the REITs. And so basically their prices start to go down. Then I have the S&P 500. The S&P 500 in the long term, based on historical data, and pay attention, historical data, they are not guarantee of the future. But based on the historical data, the S&P 500 has given something like 10% a year. The disadvantage is that it's just an index of big cap companies. There is no exposure to mid and small cap. That usually they have a higher return. Now, another asset class is gold. Gold now is on the mouth of everyone because gold is around 3,000. And it's considered a hedge against inflation, as also an alternative currency by some countries. The disadvantage is that when inflation rises, the central bank increases interest rate and the yields soar. And unfortunately, gold does not pay yields. So here, the discussion about gold, it's quite huge. There are a lot of different mindset around gold. According to some investor and good practice, you should have part of gold in your portfolio. According to other investors, you should not have it because, for instance, does not pay any yields, does not produce anything. Okay, so here it's more or less about you. Probably I will do another, let's say, video around gold if we have to consider gold in the portfolio or not, if we have to put it or not, but this is another subject of discussion. Here we are just basically doing a list of possible asset classes that I can use basically to build a portfolio and basically to beat inflation and also to raise up a bit some money. Now, another one, as we discuss when we talk about REITs, are the TIPS, the Treasury Inflation Protected Security. It's a type of treasury bond indexed to inflation to protect the investor from inflation. And you can have different flavors, 5, 10, 30 years. The thing is that they are sensitive to interest rate change. And in case of an increase in the face value of the bond, you have to pay more taxes. And what is the way that we can use to invest in these asset classes? But ETF. ETF is a fantastic instrument that we can use to invest in this kind of classes. ETF are the Exchange Trade Fund. It's an investment fund holding multiple assets, and it can be bought like a stock. The advantage is that they have a low expense ratio. Ora, ETF tracks an investment strategy, can be an index, can be a sector, can be a theme like AI, defense, water, whatever. There are tons of ETF, really tons of them. For the time being, I don't want to discuss more about ETF because it's more really to have a kind of strategy to protect, a kind of introduction to have a strategy and to understand what kind of asset class I can use. And ETF, it's a fantastic instrument when we want to diversify a portfolio. We want to invest all around the world. And for instance, we want also to buy different kind of asset classes like bonds. Sometimes, according to where you live, you can buy certain kind of bonds, but you cannot buy other kind of bonds because they are from another state, and if you are not a resident in that state, you cannot do it. So ETF allows you basically to do this kind of investment. To have more information, you can check on website like Just ETF, for instance. You can search there, and then you can have some kind of information about that. Now, we have talked about the compound interest, but what is the compound interest? The compound interest has been defined by Warren Buffett as the eighth wonder in the world. Basically, a compound interest involves earning, but always owing in other cases. But let's focus on the earning of our investment. Earning interest on interest. And this is really the wonder. It is the interest calculated on both the initial capital and all the already accumulated interest. So, the longer compound interest works, the faster the money will grow. And the faster, basically, let's say, you will become rich. Of course, becoming rich depends also how much money you want to invest, and depends also if you basically invest in the right way. But then money will grow faster thanks to the compound interest. Now, let's see a bit what's going on if I have an accumulated interest on $10,000, 10% annual interest, and here I have different kind of compound strategy. I can have annual, 6 months, 3 months, or monthly. And of course, if I started to basically get interest every month, it means that my money starts to work immediately the next month. If I have, as in many cases, interest every year, that is different because here usually, you will get interest probably at the end of the year. And so the money will start to work next year. So the compound interest will start next year, working on the interest that you have earned the previous year. But then this diagram, it's very nice because you can see what is the difference between having something annually, semi-annually, quarterly, and monthly. But especially you can see how you start from 10,000, you have 10% of annual interest, and then you can see how the compound works. You don't invest additional money. You just start from 10,000, and in 10 years, you have a good amount of money. That you would never have this kind of money if you would have left your money on the bank account, in the mattress, or somewhere else without really doing any kind of investment. And just to be clear, 10%, it's what basically is given by the S&P 500 based on historical data. And once again, historical data doesn't mean that in the future we'll behave in the same way. But based on the historical data, the S&P 500 has returned 10% a year. So it means that earlier you start, the more compound interest can work to grow your saving. Even on small account, this is something that many people don't understand, or probably they just don't even imagine. Start as soon as possible to save and to invest money, even a small sum of money. Why? For instance, we have $100. Imagine that this one is my plan, $100 a month investment and 5% annual interest in 20 years. First thing, imagine that I just have the money. I just put money aside. Okay? I don't invest them. So I start from zero. I put $100, and then after 20 years, I have more or less 24,000, more or less. So I have a certain amount of money, and this 24,000, it's a nice amount of money that I can use considering the effort of saving up $10 a month. I can use $24,000 for, I don't know, culture, professional improvement, some study, open a small activity. I mean, I can use them, or I can keep saving for my retirement. But my investment that I have done can be an ETF, can be, I don't know, a high dividend yield stock, has given me 5%. Can be the dividend yield, but can be also, just a growth stock. So I have a 5% annual interest rate. So if you can see, my investment is more than 4,000. And this is thanks to the compound interest. Because I keep reinvesting my dividend. I keep, let's say, if you invest, for instance, in an ETF like the like SPY or the VO, the Vanguard SP 500 index fund, the compound interest, so everything is automatically reinvested. So in that case, if you have this kind of growth, you can go from 24,000 to something like 40,000, just with with $100 a month. Now, let's see in the SP 500 between 1957 and 2025, if I would have invested only $1 with and without the compound interest. So with the compound interest, I have the blue one, the blue bar chart. Without, I have just the orange or yellow. It depends, but well, it should be orange. So here you can see the very huge difference. So, and how the compound interest has worked. Now, compound interest is the eighth wonder of the world. Now, let's just see some ETF examples. So, if I talk about tips, I can have the iShare tip bond, I can have the Schwab US tips, I can have a Vanguard short-term inflation protected bond, and so on. So these are just examples. There are much more, there are a lot of them. You can have short-term, you can have a mid-term, you can have long-term. So my advice is always to check the datasheet of each one of them, check the performance, check all the different information before doing any kind of investment, and especially if you don't feel safe, also ask to some professionals. Other example about the real estate. I have the VNQ, Vanguard Real Estate Index Fund, for instance. If I talk about SP 500, I have the famous SPY. And then I have the VO that I has already mentioned. Then about bond. As I said, sometimes it's difficult if you want to buy a bond and you live in another state and so on. So ETF, it's a very convenient way. It's very nice and easy way. So I can have here again tons of different flavors of ETF bonds. It can be total bond market, total world bond, total international bond, 0-3-month treasury bond. So there are many of them. Always check basically the data sheet and check what you have inside of this ETF. So I really thank you a lot for your attention. I hope that you have enjoyed. If you like it, please put a thumbs up, subscribe, and see you soon for the next episode. Thanks a lot, guys.